Hi, everybody. Today I wanted to walk you through the process of closing your accounts. So closing our accounts is something we do at the end of each financial period. And the process of closing really just means to reset those temporary accounts, the accounts that measure changes over a period of time to zero. And we close them by closing them out to a permanent account. So let me first talk about the difference between the two. So temporary accounts are, like I said, those accounts that we want to use to measure the amount of something that happens over a time period. So revenues, we want to measure how much revenues we received for a month or for a year, as an example. Expenses, we want to measure the amount of expense we paid during the same time period. And then withdrawals, we want to measure how much the owner pulled out of the business during a given month or quarter or whatever, a time period. And then finally, the income summary account, which you haven't learned about yet, because it's a special account we only use for closing. So those temporary accounts will have balances at the end of a period of time, and we want to close them out to what's called a permanent account. Those are accounts that don't measure changes over time, but give us a balance of the account at a given moment in time. So assets, what the business owns; liabilities, what the business owes, and then the owner's capital, the amount of the business that belongs to the owner. Anyway, so when we close accounts, like I said, we're just closing them out to the permanent accounts. So let's walk through how to do that. So this again just explains what I just said. We reset revenue, expense, and withdrawal accounts to zero. And then we're going to summarize the period's revenues, expenses in what's called an income summary account. All right, so here's the process. We have, we're going to first close our income statement. The way they do this one is our credit balances. Okay, so that would be our revenue accounts. And the way we close them is the revenue accounts will have a credit balance at the end of the month, because that's their normal balance, and that represents a positive revenue that we've earned. So we know that to make the balance of the revenue account zero, if it has a credit balance of 7,850, all we have to do is debit that account 7,850. So if we do that, then the consulting revenue would have a zero balance because it had a credit balance of 7,850 and we debited the account. But we can't just debit one account and not do something else. This is dual entry accounting, and there always has to be two entries. So what we do is we debit our consulting revenue account and we credit this special account called income summary. We're going to do the same thing to our rental revenue. We'll debit 300 and credit income summary 300. And so together, the 7,850 and the 300 will be crediting income summary a total of 8,150. So what that does is it returns the balance of our revenue accounts back to zero and lets us put that somewhere into income summary. Our expense accounts will all have debit balances. Why? Well, that's the normal balance of expense accounts, and it represents having had expenses during the period. So again, we will credit that account, each expense account, by its current debit balance to make the balance zero. And the total of all of those, we will debit to the income summary account. So we'll debit income summary and credit the individual expense accounts. Now all the expense accounts will have zero balance, and income summary will have some balance, right? In this case, we debited income summary 4,365 to close our expense accounts, and credited income summary 8,150 to close our revenue accounts. The new balance of that is a credit balance of $3,785. Now, the only issue with this is that income summary is also a temporary account that we're going to want to close. So to do that, if it has a credit balance of 3,785, we'll debit income summary 3,785. And since we're debiting that account, we'll have to credit somewhere, and we'll credit the capital account. So if you think about it, when we do our statement of owner's equity, what we're doing is transferring our net income, right, to our owner's capital. That's what happens on that statement of owner's equity. And if this is the actual journal entry process of doing that, we close revenue to income summary, we close expenses to income summary, we find the balance of income summary, which represents our net income because it's our revenue minus our expenses. And then we close that to the owner's capital. So now we've taken these temporary accounts, returned them to zero, and moved the balance of those accounts over to our owner's capital. The last thing we have to close out is our withdrawals. So in this case, the withdrawals will always have a debit balance. So to close it, we'll credit the withdrawals, and then we'll debit the owner's capital. Recognize that withdrawals decrease the owner's capital. That's why we're debiting it, because its owner's capital is a equity account, so it increases with a credit and decreases with a debit. So when we close our withdrawals, we'll credit the withdrawals account and debit the owner's capital account. So this whole thing has the impact of saying, well, our owner's capital at the beginning was 30,000. It increased by 3,785 due to the net income, and it decreased by 200 due to the withdrawals. So at the end of the period here, we have a balance of 33,585. So if you think about it, this whole closing process sort of goes along with the statement of owner's equity, because it shows the balance or the owner's equity before, the addition of the net income, the subtraction of the withdrawals, and the new balance. So after we do that, we'll have what's called a post-closing trial balance. This will be the balance of all of our accounts after the closing process. So you'll notice that on the post-closing trial balance, there are only assets, liability, and equity accounts. There will not be any revenue or expense accounts or withdrawals, owner withdrawals, because they've all been closed. They all have a balance of zero. So once we've closed everything, we create a post-closing trial balance, and that's our balances now for starting the next financial period in January. And that's the process for closing our accounts. Again, I hope that's helpful to you. And as always, don't be afraid to reach out if you have questions.